how it may impact Wall Street as a man who founded his own hedge fund, Anthony Scaramucci, founder and co-managing partner of Skybridge Capital. We'll talk Bitcoin and so much else. But Anthony, I'm curious what you think could possibly come out of tomorrow's session and what you're looking for.
Well, I think the principal focus, good morning, Andrew. I think the principal focus is going to be on the order flow payments and the discussion between what happens with Robinhood and places like Citadel. I don't think the focus is necessarily going to be on the hedge funds. The hedge funds really didn't do anything wrong. They got short stocks, which they're totally allowed to do. They were short in concentration, which got picked up by the Reddit people. And exploited at least temporarily by the Reddit people. But I don't see this being a target practice on hedge funds tomorrow as much as it is the little guy getting squeezed here, or is the little guy being hurt? And I think that what regulators already know is that the laws in place are actually to protect the system more so than the individual investor. And it's not really clear, Andrew, how you could do more to protect the individual investor. This is sort of a caveat emptor situation.
Anthony, here's a real question, and I think underneath all of this is the game rigged? Is it a fair fight? If I'm sitting in my pajamas with my laptop or on Robinhood on my phone, do I have a real chance against the pro who has access to data and resources? And frankly, is doing this professionally. I mean, some people have compared this to, the professional golfer versus the weekend duffer. Does the duffer really have a chance against the professional?
Well, listen, we both know that the professional has an edge if you just think about the size and scale of things. But never before in history, Andrew, has the individual investor come this close to parity. And if you just step back for a second, the individual investor has the same capabilities as a prop trader at any of the legendary firms circa 1995 or 2000. They have costless trades and they have near perfect instantaneous information, and that's exactly what people had 20 or so years ago. But I don't believe that they have an edge, and I don't believe that they're ever going to get to parity. I think the question is, should they ever get to parity? And the answer is, well, how can they? If you're staffing with 150 traders and you've got, $20 billion of capital under management, of course it's going to be, there's going to be an edge there. I think what you want to make sure of is that they're not being disadvantaged by the system, whether it's the frequency trading, the high frequency trading, or it's the payment for order flow that could tip people off directionally.
This is for educational purposes. Notice he said you don't want to be disadvantaged by the system.
But effectively, the argument is that the economics of Robinhood are being paid for by Citadel because they're paying for the order flow, and there is a view that Citadel wouldn't be, quote unquote, paying for that order flow if it wasn't somehow meaningful to them, right?
Well, yeah, listen, no question. Of course, they're paying for that order flow because they want to do those transactions and they want to see the momentum of where things are going in the market. But listen, again, Robinhood is fully disclosing all of that to their investors. If you log onto their account, you look through the fine print, they're explaining to you why your transactions are costless. People should know that. That's the age-old thing on the internet. If the service is for free, you happen to be the product as opposed to anything else. And I think people understand that. And so remember, Robinhood's also making money off the float. And so when there are margin accounts at Robinhood, that's also very lucrative for Robinhood.
I mean, what about short selling? Because one of the things that happened during this situation, and the reason, to the extent it worked for anybody on GameStop, at least initially, was because of this short squeeze. And in particular, you had folks like Chamath Palihapitiya and others come out and say, look, this is a stock that was shorted. 140% of the shares were shorted. And people said, I don't understand that. That's irrational. It can't be that more than 100% of the stock was shorted. Technically, it can because people are buying, then borrowing it from somebody else, selling it, and continue it over and over and over again. But the question is whether that needs to get cleaned up.
Yeah, but you also have naked option strategies in the marketplace, which is creating that additional, imbalance in the float, if you will. Listen, you can't get rid of the short selling. So this is the vexing dilemma for the regulators. They want to protect the little guy, but at the same time that they know that the short selling is a curing process in the market. It helps to discover fraud. It helps to uncover things that are nefarious in the marketplace, and it keeps people more honest. And so you have all of these different variables hitting at the same time. And listen, as Kevin O'Leary said earlier in the show, the Reddit guys are pretty smart. They know what's going on, and they have to have that caveat.
Anthony, do you think this changes investing though? Forever. I mean, some people have said this is like the financial version of the Arab Spring. Now that you have this sort of social media enabled collective that can actually go either after a short squeeze or just pump a stock one way or the other. I mean, I guess the question I'd ask you is this some kind of newfound approach to investing, or is this a pump and dump on the other side? I mean, a lot of people have different views on this.
Well, listen, it's definitely, if you're a hedge fund manager, you have to adapt to this. You have to look at your short interest. You have to look at the volume that's out there in the short interest and the concentration, and you have to be wary. And so hedge fund managers are already spreading out their short interest, becoming more diversified, and tightening up their risk management protocol.
This is recorded on February 17th, 2021 for educational purposes.
Revolution, or the Arab Spring, is that the micro investor now is empowered. They're empowered with near perfect information and costless trading, and a result of which, if you're a professional investor, you have to recalibrate yourself and make that adaptation. So yes, I think things have changed, Andrew, but you can still get very badly burned in these situations. And my warning to individual investors, no matter how smart you are or how close you are to the information, be careful, put in stop losses. Allow yourself to get called away from things when necessary so that you can live to fight another day. You and I know that there are very bloody stories out there where people have borrowed a lot of money and got burned on these stocks, and it's impaired their ability and their lifestyle, basically impaired their financial capabilities, if you will. So, I want people to be cautious. The game has changed, though.
Yeah, maybe it has changed, Anthony, because I can remember in the old days when people would complain about trying to compete with the big guys. As a retail broker, I would say, big guys are like elephants. You try moving around like an elephant if you got a huge position. There's actually some things that make that difficult, and sometimes smaller investors were able to move around, at the feet of the elephant. I guess you can get stepped on by the elephant too, but that case is never made anymore about, when you have these huge positions, there are negatives to that too, and so there are some advantages, I think, that we don't point out anymore to being at least more nimble for smaller investors. Is that not true?
Joe, I definitely think that, Joe, but on the other side of that, if you look at the technology that these big hedge fund managers have, or a company like Citadel, or the high frequency traders, they're moving so much volume. Back in the day when we were doing that together, or that I was once a retail broker, I think that was a lot clearer back in the day. But today, with this advanced technology and the high-speed trading, Joe, I think the edge is full with the pros.
That's true, but I think it has changed. That's why I said that. But that was what we used. That's what we used to. That's how we used to say. No, it's not so bad. But maybe we were, just selling ourselves. Anyway, go ahead, Anthony.
Anthony, real quick, because I know you got to run, and I know you're in the business. You got a fund. You got a Bitcoin fund. But are we going 100,000 first, or are we going in reverse first?
Well, listen, the thing is volatile. Again, I want to be cautious with individual investors, but we like it. We have over $500 million in Bitcoin right now. And obviously our Bitcoin fund started in December. It's done quite well, but be cautious. But Andrew, I do think we see $100,000 in this coin before year end. It's just a supply-demand situation. And you don't have a lot of supply out there, and very heavy demand. And lastly, just look at what MicroStrategy just did. A $900 million convertible bond offering instantaneously. Those are two pretty hot sectors right now, converts and Bitcoin.
Right. Okay. Anthony, great to see you. Come on back. We'll talk soon.
Good to be here, Jay.
Thank you. Joe?